So after our conversation with Sandy from Franklin Templeton, we were just having a chat after the fact, and she said, "You know what? You got to check out, Ryan. This is going to be," and David was there too. This is going to be massive for crypto. There is a new. I'll call it benchmark, but you might use a different word like reference rate, for instance, for crypto that this guy named Chris is heading up over at CoinFund, and it's called Caesar. And I said, "Oh, okay, well, tell me a bit more." And she told me more. And I said, "Well, that sounds a little bit like Libor for ETH, right? Reference rate Libor, which I understand is kind of like a big deal in traditional finance." And I said those words, not fully understanding actually what Libor is used for in TradFi, just knowing that it's one of those things that is incredibly important. And I'm wondering if you could kind of take up the conversation from there. Both tell us what you're building and why it's relevant for Ether and Ethereum, and what you think the potential is here. But maybe start the conversation in this context of when somebody talks about a Libor for ETH, what are we talking about? Like, what is Libor? Maybe we should start there.
Yeah, let's step back. So interest rates they're the pillar of modern day finance, right? There's nothing more important than interest rates. You turn on your Bloomberg in the morning, they talk about companies a little bit, but they mostly talk about the Fed and they talk about interest rates because interest rates drive everything. The thing about interest rates previously is that they're very centralized and highly controlled, whether that's the Fed that sets rates. They do it a few times a year. It's not open, it's not transparent per se, and people are always betting, what's the Fed going to do, right? That is modern finance, like it or not. Libor was a rate, and I said was because it was incredibly important back in the day. It underpinned hundreds of trillions of dollars in underlying financial assets, right? It underpinned loans, it underpinned hundreds of trillions of dollars in derivatives, everything keyed off of this rate. And this rate was set by a bunch of, it was the London Interbank Overnight Rate. So it was a function of the rate at which banks lended to each other. And the funny thing was that it was determined by a handful of traders at a couple of banks where they would submit bids every day and that rate would be produced. Over time, it suddenly leaked out that that rate was being manipulated. And think about it. You have hundreds of trillions of downstream products that are that people either have to pay or receive based on this rate, highly controlled and totally manipulated. Insane. And so after that, and I don't even think they understand yet just the financial consequence of this manipulation. Go back and you can read about it. But fast forward to today, there's been a lot of rates reform across traditional finance. They've replaced Libor in many cases with a new rate called SOFR in the US. The other thing about rates is that they're very regional, right? So you have Ionia, you have Sonia, you have all these different rates throughout the world set by different governments. But let's fast forward now to why Ethereum staking is so incredible, right? And by the way, in traditional finance, even today, the largest derivatives market in the world is the interest rate swap market, interest rate derivatives. This is a $500 trillion market, right? The size of this is incredible. And why are interest rate derivatives so important? Because they give incredible utility, right? If you want to go get a mortgage, you can get a floating rate or you can get a fixed rate. Well, how do you get that fixed rate? Somebody swaps fixed versus floating, right? So it gives incredible utility to the consumer. So before the merge, we were sitting around at CoinFund and we were just like, wow, when we go through when we transition from proof of work to proof of stake, oh my gosh, we're going to have the first real interest rate in crypto. And this is going to be incredible because, and really what it comes down to, it already exists, right? Like it's out there, you can observe it, it's on chain. But if we can build social consensus around an observation period, right, you can compose so much around it, right? And again, how do we bring in all of that utility of whether it's the interest rate swap market There's a bunch of different applications I'll get into, but the whole idea here is that with proof of stake, you essentially have a kind of like a Libor, but it's global in nature. It's open source. It's completely observable and completely replicable. And if you build social consensus around a standardized snapshot, you can effectively build like what we have in traditional finance, which is a forward curve. So you can project that rate in the future, and you can build all next generation financial products around it. And so really there are two primary use cases for a benchmark of this nature. And maybe I can talk through, before I get into that, maybe how we constructed it. But really there's two fundamental use cases. One is for benchmarking, and the other one is to transfer risk.
In one way, it seems like this reference rate is kind of like what we in crypto would call an oracle, right? It's kind of like a data feed that power, you know how like Chainlink oracles power so much of DeFi? You know, Libor was essentially a reference rate that powered many of the, we'll call them contracts, TradFi contracts in real life. Is that a useful way to think of that for a crypto native, like Libor just being sort of like an oracle?
Not really an oracle. So like an oracle would deliver that rate to a smart contract. Does that make better sense?
Okay.
Yeah. So it would like it's more of a price itself rather than an oracle.
It's more of a price itself rather than the oracle, and yet maybe the way it was related in my mind is that it that rate really matters, right? Like it sets a lot of the I guess you said there were hundreds of trillions of dollars that were underpinned by Libor. When you say underpinned by Libor, what do you actually mean? So how is this price feed essentially being like fed into the hundreds of trillions of dollars, and what happens or what did happen in the case that there's an inaccuracy?
Yeah. So one of the most prolific products in traditional finance is something called an interest rate swap. Okay, we call swap something different in crypto land, but in traditional markets, a swap is a derivative, and usually it's with where one side pays fixed and the other side receives float. Okay, and so, or you can have something called a basis swap where it's floating versus floating, which I'll get into in a second, right? But why would somebody want to receive or pay fixed? It's because they have a view on where those interest rates are going. And if somebody wants to hedge themselves from a spike in the rate, well, then maybe they're going to pay fixed and receive floating, if that makes sense. Or the opposite way around, where they want to understand where they're keen to receive a fixed cash flow. They're happy to pay a floating rate. And so like a good example of that is like a fixed rate mortgage, right? People want a fixed rate mortgage. And so what the bank does behind the scenes is they'll swap out fixed for floating in order to give that product out to a consumer. And so interest rate swaps, and I think you guys had Simon on from Volts back in the day. He talked about this market, but it is the largest derivatives market in the world. Or you can have a view on two different floating rates. That's called a basis swap, which is floating versus floating. And so like, you know, I can talk about why that's applicable in Ethereum land, but this is a very, it's the most common, most prolific derivative in the world.
Okay, and I called it an oracle earlier, and your comment was maybe it's more like think of it as a price feed, but it is determined by, you said, a handful of traders, right? And you were talking, you kept using the term "was" for Libor because it sounds like maybe it doesn't exist in the same form it used to. I recall in was it 2012, kind of the Libor scandal. Took hold or became evident and became public information, and it was essentially being corrupted, right? So this is sort of like the traders who were corrupting it. Like what were they doing? What benefit were they sort of corrupting it in ways that would give them an advantage, or how exactly was it being corrupted back in 2012?
So they would have traders would have a book, and they would be positioned in that book to make money depending on whether that rate went up or went down. And so, or people within the bank would have certain positions where, like, if the rate went up or down, they would stand to make or lose a lot of money. And so there would be, according to public documents, they would whisper in some of these folks' ears and say, hey, bump that rate up. And a little change could result in billions of dollars of P&L. And so there was manipulation of that rate. And when they submitted those, their levels to create and settle that rate every day, it reflected the risk that they had on their books, and so that they could profit in certain cases rather than lose money for their own books. But the downstream implication was just massive.
This was a huge scandal at the time, right? Like, what happened in TradFi when this was revealed?
Yeah, huge issue. There was all types of fines, billions of dollars of fines to the various banks. You can go back in history and look at it. And then there was a number of benchmark reforms where Libor was essentially phased out in favor of rates that were more transactional based. One of them was called SOFR as an example. So there was, it was a massive issue, cost the banks billions of dollars in fines, and then even more money to try to figure out the way forward. So it was a huge challenge.
Yeah, I was going to ask you, because it's so fascinating, because in in crypto we're all about creating corruption resistant protocols, and it sounds like this price feed in particular was not as corruption resistant as it needed to be. And I'm wondering, with some of these other reforms like the SOFR that you mentioned, are they, I guess they're trying to add a layer of corruption resistance through better protocol design, just trying to translate this for crypto natives a little bit, and through regulation, right? And so that's kind of like, I guess, the traditional financial system, that's their way of doing it. Hey, we'll kind of design this a little bit differently. We'll add additional regulation. We'll put some more kind of like checks and balances. And are these new reference rates, these new benchmarks, are they more corruption resistant? Are they better? Did they, like, quote unquote, fix the problem that was with Libor, or do they still have like some holes in them as well?
Well, I guess time will tell, but they tend to be more transactional based now. But this is just one of many different rates. I mean, look at the Fed itself; it sets rates as well. And I think the point with traditional rates that we see is that they're very centralized, right? And wouldn't it be amazing if we had decentralized rates that were more transparent and observable? So, is anything perfect? Maybe not. But they're trying to get away from this like dark room they're trying to abstract and eliminate an ability to manipulate. But I don't know. We'll see how it goes.
To continue leveling up your crypto game, then you need to get on the Bankless newsletter. It's the world's most popular crypto email and is completely free. Just click below to sign up.